My sense is that it's generally a part of the world that is not well understood. People traditionally have not spent a lot of time analyzing Ukraine. And so when we don't understand something, we tend to err on the side of caution. But I think people also broadly recognize that in this day and age, a full-scale confrontation between the West and Russia is most unlikely. And if you also look at the Ukrainian government bonds themselves, they're trading around, depending on the maturity, 80 to 90 cents on the dollar. If they were going to default, they'd be trading 20 or below. So there's also a understanding that the financial responsibility for Ukraine has shifted from Russia to the West, and the West is willing to cover those obligations. I can't think of anybody who benefits from Ukraine, but I would say that Russian equities have clearly collapsed, and if you add on the fall in the Russian ruble, if there is some kind of resolution there, clearly the upside is most obvious in the Russian equity market. It's not a market that we traditionally recommended because we don't like corporate governance there, and it tends to be very commodity heavy. We also don't particularly like commodities. But that would be the area naturally to look for a bounce when a solution occurs. As for emerging markets as a broad asset class, if you look back over the last 10, 20 years, every year there are pockets of opposite performance to the broader asset class. So what I mean, for example, last year emerging markets as an asset class were down, but there were select emerging markets like Malaysia, like Taiwan, which were actually up quite nicely. So I think this year it'll be a mixed bag for emerging markets. Some will be up, some will be down. And we're already seeing that actually. We're already seeing that this year. Best performing markets in Asia are Indonesia and Vietnam. Worst performing markets are China and Korea. Well, I think we see fair value for gold at about $1,100, and clearly we're not there yet. But if you look at the shares outstanding in the major gold ETFs in the United States, they're actually pretty close to where they were before Lehman Brothers. And that was where, after Lehman Brothers, you had a massive amount of gold buying in the United States and all over the world. But people bought a lot of these investment products related to gold, and that's been the major driver of gold since 2008. So the fact that we're back to those kind of levels we were at there, or close to it, gives me some comfort that that a lot of the selling is over. But when I also look at just a long-term chart of equities versus gold, and I can take it all the way back to 1955. This is typically a ratio which goes through 10-year bull-bear cycles. So you get not just a 1 or 2 year outperformance of equities versus gold, or underperformance, but it's a multi-year trend. And we're only now 2 years into outperformance of equities over gold. Just looking back at that chart, I struggle to believe that gold is going to start outperforming equities now.